All right. Well, good morning, everyone, and thank you for joining us for our livestock insurance webinar with our very own Sterling Watkins and partner, Dr. Marin Bozic. As we go through today's presentation, we hope you engage with our speakers. Feel free to do that. You can do that by using the chat feature at the bottom of your screen. Chat any questions you may have, and we will do our best to get those answered at the end of the presentation. To get started, I'd like to welcome and say thank you to Dr. Bozic for joining us this morning. Marin Bozic is an assistant professor in the Department of Applied Economics at the University of Minnesota. He serves in a leadership role in several organizations. He is an associate director of Midwest Dairy Foods Research Center and the facilitator of Minnesota Dairy Growth Alliance. Marin is also a member of the National Program on Dairy Markets and Policy, which is comprised of a team of dairy economists who recently won a national award for their outreach work on the 2014 Farm Bill. Before we get started, as a reminder, this webinar is intended for informational purposes only and not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. So with all of that out of the way, Dr. Bozic, if you are ready, we appreciate your time and go ahead and take it away.
Good morning, everyone. Thank you for having me. Michael, can you just confirm that you hear me well?
We can hear you, yes.
All right, wonderful. So Mike introduced me as an academic. I will not be wearing that hat today. Today we are talking about livestock insurance programs, in particular 3 of them that are managed through the Risk Management Agency, and my company, creatively called Bozic LLC, is what's called a 588 submitter on these programs. Think of that as a geek squad that works behind the curtain to make sure that these programs function well, that are effective for managing risk for livestock producers, and that the rules are continuously updated to match the evolving markets as well. So these programs are public-private partnerships. They are subsidized by the government, reinsured by the government. Government ultimately approves all the rules. Agents such as your good Sterling are the ones communicating with producers, and the insurance companies are carrying the risk or most of the risk. My role here is as an educator. I don't sell insurance myself. I'm not an agent, and my role is to do the economics behind the scenes, set the premium rates, and make sure that the programs function well. So what do we have on the menu today? What can you use to help your operation? If you're a dairy producer, if you're a pig farmer, if you're a cattle rancher, what's in store for you? And my goal at the end of this webinar today is that if you're a producer that you find yourself thinking, I should really look into this. This could really be good for my business. And if you're working for Farm Credit Mid-America, if you're a underwriter, a credit analyst, etc., my hope is that you will leave this webinar thinking, you know what, just like we require or we ask our crop clients to have crop insurance when we support them financially, we should look at how we can best support our livestock producers who choose to use insurance, and how insurance can be part of the overall approach of doing business that is something that we look at when we approve loans as well. So the 3 programs that we will be talking about today are dairy revenue protection, livestock risk protection, and livestock gross margin. So let me briefly introduce each of them. Dairy revenue protection is for dairy producers, as the name says, and it offers protection for reduction in gross income or revenue from milk sales. It has nothing to do with labor costs. It has nothing to do with feed costs. It focuses on revenue that you get for your milk. And there are two reasons why why your income from milk sales may go down. First, prices may go down. And second, your cows may not be as productive as you thought they would be. For example, bad weather, or it's too hot, or it's too cold, or it's too muddy, etc. Like something can impair, or the feed quality is not as good. Something can impair how much milk your cows produce. So dairy revenue protection is akin to an area revenue protection in crops. So those of you that are familiar with SCO or ECO, you know that ECO doesn't ask you what your yield on your farm is. They look at a county yield. In the same way, dairy revenue protection doesn't ask you for your DHIA records, doesn't look at what your rolling herd average is on your farm. Rather, it looks at your state, what's happening in that particular quarter. So if the whole state went down below the expected, then DRP is going to compensate you for that. We'll talk more about DRP, and we'll show you a little bit the software that we developed for exclusive use by farm credits, now used by 14 farm credit associations, and Mid-America included. So we'll show you how we can support your decision making there. Livestock risk protection is very similar to a put option. It does not cover anything related to the lower weight gains or death loss of animals, etc. It focuses on lower price per hundredweight or per head of your animals. It focuses on swine, feeder cattle, and fat cattle. So those three segments of livestock producers. And it also doesn't do anything with feed costs, doesn't do anything with labor costs or anything else. It just focuses on how much money are you getting for your pigs, for your feeders, or for fat cattle. Livestock gross margin tries to go a little bit further and recognizes that even if milk prices or pig prices or cattle prices are good, you will still not make money if the feed costs increase unexpectedly. So the LGM, or livestock gross margin, is LGM. It ensures the margin between the revenue that you get from the sales of your products, of your livestock or livestock products, and the cost that you have to make those products. So we'll go in a little bit more detail on that as well. There are some common elements that I want to review here. First, the expected prices. Expected prices are based primarily on futures markets. It's not one-to-one mapping, that there's typically some sort of averaging or transformation, but in general, it's always going to be the truth that if the futures markets go up, the prices that you can cover through DRP or LRP or LGM, they're also going to go up. And no farmer-specific information is used on this. So whether you ship to Dairy Farmers of America or Michigan Milk or somewhere else, that doesn't matter for the prices that you're able to protect or for the indemnities you receive. We only look at the national prices that are common to all, such as Class 3 and Class 4 futures, such as lean hog futures in case of hogs, feeder cattle futures, and fat cattle or live cattle futures for fat cattle products. This also means that prices change daily. Now, if you have experience with corn or soybeans, you know that there's always a talk about sales closing date. March 15th is the holy date in that world where you have to make a decision for the next crop. Well, with livestock, it's a little bit different. Sales closing date is every day. Every day, the new prices come out, new opportunities come out. So if you didn't cover yesterday, you can come back today. You should not wait indefinitely because prices can sometimes go down, and you can only offer prices that are based on what the market is offering on that particular day. And then similar to crops where you cover, for example, in case of corn and beans, you cover in March for crops that you're going to harvest in fall. So there's like 6 months, 7 months span of that growing cycle, of the growing season. In livestock, we offer something similar in a sense that you can buy coverage starting for about 2 to 3 months out, all the way to 15 months out in case of dairy. And it works a little bit differently from one commodity to the next. But the general principle is that we wanted to offer hedging horizons or coverage horizons that are long enough to be meaningful. Because if you're, for example, protecting milk only for the next quarter, that's not going to matter much when we have a situation like COVID and a crisis lasts for a year. You will, in general, want to be further out. And these programs allow you to do that in a very affordable way, much more affordable way than the markets. Let's talk about how do we go from expected prices to guaranteed revenue. We allow producers to select the deductible, and it's very flexible. Now, in case of dairy, almost everyone goes with the highest available coverage, which is 95%, or 5% deductible versus where the markets are on that day. In case of livestock risk protection, people choose even closer to the money. A typical deductible is half a percentage point to maybe 2 percentage points or something like that. Vast majority of producers that use LRP use it at the highest coverage level available, which is virtually no deductible. And then for livestock gross margin, what we find is that people typically use it as a more catastrophic coverage, that their deductibles are bigger. The equivalent would be of the coverage levels being lower, and the premiums that they pay are typically lower as well. How much you can hedge or how much you can cover with these programs is also very flexible. So those of you that are more familiar with crop insurance know that there are sometimes rules that you have to cover all your acres in a certain county in order to get the premium discounts, et cetera, et cetera. There are different types of unit structures there. When it comes to livestock, if you're marketing 10,000 pigs, you can still cover only, I'm going to use a ridiculous example, you can cover 5. Like, you don't have to cover 50% or 75%. You can start small, dip your feet in the water, if you will, see what these programs are about, and then grow your coverage as your comfort level with these programs also grow. And then finally, let's talk about premiums. The premiums vary day by day. They vary with the market perception of risk. So if the CME markets are rattled, if the options are very expensive, if market anticipates that there is going to be some big announcement from the government and that may push the prices either strongly up or strongly down, depending the way it goes, then these livestock programs are also going to be more expensive. However, they differ in 2 important ways from what you would have to pay for coverage on CME. First, they're subsidized. The subsidy varies from 13 to 55%. So typically on DRP, you would have a 44% subsidy. On LRP, you would have 35% subsidy. That's the lowest subsidy that you can get on LRP. And then for LGM, you can, if you want, take 0 deductible, but it's really tiny, as the subsidy is very tiny, but it goes very quickly up to 50% as you choose higher deductible. And then another thing to keep in mind is that for all 3 of these programs, it is true that they're very cash flow friendly, because just like in crop insurance, you don't pay the premiums up front. You pay the premium when everything is over, when the coverage period that you've had covered under your insurance, when that has transpired at the end of the day, and the end of the quarter, and the end of the month, and the end of the, like, whenever that happens. So it's very, very cash flow friendly. If you were doing any kind of risk management with CME, you either have to establish a margin account and cover any losses in real time on your hedging position, or if you're buying puts, for example, you have to pay the put premium upfront that same day. The coverage doesn't attach, as the put does not belong to you. You don't own that put until you have paid the premium in full. And then when it comes to paying indemnities, actual prices also don't depend on what you got for your swine or for your cattle. They depend on the prices published by RMA that are, again, based on feeder cattle index or lean hog index, or class 3 and 4 prices in case of dairy. One thing to keep in mind there is that this insurance is for our good livestock producers. It's not for me and Sterling, for example. Maybe Sterling has some cattle. I don't know. I don't. I only have 2 kids. Sometimes they behave like livestock, but I can't insure. I cannot buy insurance on them. So you have to actually provide some evidence that you have marketed milk, or that you have sold your cattle or that at least if you have not sold your feeders, for example, if you decided to retain them, that you still own them. You have to certify that you still own them. So there are some checks and balances that people don't abuse these programs, but they're very producer friendly, I would say, and we continually evolve these rules to if anything is awkward, if there's any red tape. We don't always get things right in setting the rules, but we are very willing to and eager to hear from producers and agents on what's working, what's not working, so we can improve the rules for next crop year. I want to point out to you that this is not an academic curiosity anymore. When I got involved in this sector in 2018, the entire livestock sector between LRP and LGM total premium nationwide was only $12 million. This year we are at $879 million as of a few days ago. By the end of June, we could be knocking on $1 billion in premium. In the DRP was the first big wave. You can see that in 2019, the LRP and LGM did not really attract much attention. Like I got involved first with DRP. That's a program that I designed with my good friend John Newton, who is now a chief economist in the Senate for the Ag Committee on the Republican side. And then in 2020, I acquired LRP and we started making changes there. And you can see that in 21, LRP started growing a lot. And then in 2022, in the spring of 2022, I also got involved with managing LGM, and we have big plans for growing LGM. I believe that maybe 5 years from now, LGM could be the biggest of these three products with the changes that we have in the pipeline or that we are contemplating right now. But we have to also responsibly grow these programs because if we grow them too fast, if you will, there will not be enough insurance capacity, and producers may not be properly served as well. So we are very gently growing, if you can call this growth rate gently. Let's talk about how much is this used in different sectors. In the dairy world, when we first released DRP, it was less than 10% of milk was covered, and then quickly adoption rate grew when the COVID scare broke out in the first quarter of 2020. Almost 40% of milk was covered for the third quarter of 2020, and then from there the coverage varied between 38 and now most recently 24%. So I would say between a quarter and a third of the U.S. milk production is covered, and I believe that this number is going to stabilize in that range for a while and then maybe grow gradually over time. In the case of swine sector, what this is showing is the cumulative pigs through the last three reinsurance year. We are currently in the reinsurance year 2023, so that it's this black line here that matters. We are well on track to cover 15 to 16, maybe even 17 million pigs by the end of the year, which is June 30th for the crop year. That is still just a fraction of all the swine marketed, and we have about 130-ish million pigs marketed every year. And under the current LRP rules, some 45% of pigs would be eligible for LRP because there are some head limits there. So this sector is growing fast, but there's still a lot of growth that can happen in the swine sector. On the feeder side, last crop year, we ended in 2 million head. I think that this is numbers through late March. I think that we could be well over 3 million head on feeders covered. That is still like we market about 30 million cattle a year. So that is still just a fraction of where this sector can grow. But if you're a producer, I want to draw your attention to this, that it's not just some, my lender is pushing this, or there's some academic with a weird Eastern European accent, looks like a James Bond villain, who's pushing this on me. No, your peers are doing this already. This is booming in your sector, whether you're on the feeder side, whether you're on the swine side or dairy side. The only sector where I would say that we don't have substantial growth in terms of numbers is the live cattle or the fat cattle. We are not going to be even maybe 750,000 this year versus 30 million marketed per year. We have some changes that are going to be implemented here as of July 1, and I believe that live cattle is going to be the next big wave of growth in livestock sector in the next crop year. One major point that I want to single out here is that when you evaluate the value of these programs for your operation, you should not focus only on premium or subsidy or return on premium, but you should focus on all the money that you're not leaving on the table that you otherwise would be leaving on the table if you were just selling futures. So this is how the returns look like for what's called a class 4 milk. If you're not in dairy, that's gonna be a foreign concept to you, and that's okay. Just in general, think about it as milk for now. So these are the returns on covering milk in Indiana going 3 quarters out. So that would mean, here we are in May, the first quarter available is summer or the third quarter of 2023, the second quarter available is the fourth quarter 2020. So this would be the first quarter 2024 today, the third quarter out. Here's what I want to draw your attention to. You may get an indemnity, you may not get an indemnity, but you will never be on the hook for more than the subsidized premium. So you can see that here the losses, no matter what, losses, quote unquote losses, the premiums paid in quarters when indemnity is not received, it's never going to be than what you know on the same day when you're buying coverage exactly what the cost is going to be. There are no unanticipated costs with any of these 3 programs. And here in this case, you're looking at maybe 20 to 50 cents per hundredweight. If you were hedging with futures, if you were selling futures, occasionally there will be a market rally. And so last year, for example, we had really high milk prices. And if you were selling futures, and I know some producers that do that, this is the amount of money that you would leave on the table. Because if you're selling futures and the prices go up, then you will have hedging losses on your hedging account. So compare the losses, if you can call them losses, compare the premiums paid for DRP versus all the money that you would leave on the table if you were selling futures. So one of the major benefits of DRP for dairy or LRP for swine and cattle or even LGM is that you don't have this unanticipated expenses or unanticipated hedging losses here. And sometimes those hedging losses are not even fully offset by your hedging gain, by your cash gains, because maybe your co-op doesn't even pay you as much when the market prices rise in case of milk. So it is true that if you're selling futures, you get a little bit more when prices go down. You see this difference here between light green and the dark green? That's the additional benefit from selling futures. But you got to decide for yourself now, is this little pocket here, the difference between getting an indemnity through DRP and getting a payment on your short futures, is this little part here worth leaving all of this money on the table when prices rally? If I was a producer, my answer would be no. I would like to put a floor on my revenue, but I would like to have a blue sky above me benefit of in any market rally that may happen. So the next thing I want to do is try to convince you that these programs not only stabilize your income, they actually enhance your income. So I've often heard producers say that risk management is like going to a casino. Where I mean, I ask them, why? What do you mean? Well, say, in casino, the house always wins. If we hedge with CME, the other part is going to win. And producers would often conclude that it's better to just have enough equity to ride out the bad years and not have to do risk management. They would see risk management as increasing their cost of production without often meaningful benefits to them, because they can essentially self-insure through equity position. RMA programs are subsidized. The taxpayer, US taxpayer, wants you to use these programs because the taxpayer wants a resilient US livestock sector. They want the Americans to have our own produced milk, our own produced bacon, our own produced beef. That's what's for dinner, not something from New Zealand or Europe or somewhere else. We're all for consumer choice, but we want just like we want our crop sector to be well diversified and resilient to droughts, etc. We want that for livestock. So the taxpayer wants you to use this program. The taxpayer would prefer if you don't come to them asking for ad hoc payments in case of a crisis, but instead if everybody is well covered, and these programs provide automatic compensation when there is some major blow up such as COVID or World War or something else. So does it really work? Does this really enhance your income? Are these subsidies for real? So what we did is we looked at the last 10 years or as far back as we could go, and we asked, well, if you were regularly using these programs, if you were buying every month on cruise control, so if you weren't trying to guess, oh, market's going to pay, the prices are high, prices are low, I'm going to lose money, I'm going to make money. If you were just putting this on cruise control, at the end of the day, 10 years later, are you money in or money out? Did the indemnities exceed all the premiums that you would have paid over the 10-year period? And the answer is, for the most programs, yes, the indemnities do exceed the premiums paid. I'm going to start with the feeder cattle first. So we simulated a risk management strategy that bought coverage 167 times, 163 times, and out of 163 times, 65% of sales events, 65% of endorsement purchases resulted in indemnity. So this is really important to understand first, because just because you're buying insurance and just because it's government subsidized doesn't mean that it's that you're going to get a check from your insurance company every other Thursday. Like about 1 in 3 times you're going to get a check. 2 out of 3 times you will not get a check. That's the way it works. So the probability of indemnity, historical, is about 30 to 40%, and that's okay. In fact, some of those times when you get an indemnity will only partially refund you for your premiums, but they will not be enough to cover the full premiums. In this case, about 50 events out of 163, so just over 30%, you will actually get net check in the mail or direct deposit from your insurance company. When you look at overall money in, money out, so with in this example, we protected, let's see, I don't see how many head we protected here. But if you look at just on a per head basis, you would pay a premium of $23. This is for feeder cattle again, per head, and you would get an indemnity on average $29. $6.22 was net indemnity. When you look, if you care to look at net indemnity as a return on your premium investment, your return would be 27%. So think about money in the bank, the ads that you're seeing these days. Move your money to JP Morgan or Chase, etc. We're going to pay you 5%. 5% is a lot. It's like 7%. Ooh, like, invest in a stock market, you can get maybe 9%. That's considered a good investment. Well, with livestock products, with feeder cattle, you will get 27% over the last 10 years. That's a pretty decent investment opportunity. We also looked in case of feeder cattle, should you go with a lower deductible or higher coverage level, or should you go with a lower coverage level? And what we find is that in general, the high coverage percent levels had higher net indemnity per hundredweight. So you can see this is the green line here. If you are not taking deductible or you're taking as little deductible as possible, that maximizes your net indemnity. The third thing I want to point out is that I just told you a few minutes ago that there's a chances about 30% that you're going to get a check in the mail. That is not nothing check, nothing check. This is not tango that we're dancing here. It can be like a 1 year, 2 years, sometimes even 2.5, 3 years of nothing. You keep on paying premiums. You keep on thinking, why did Sterling get you into this? And then just as you're ready to give up, don't give up, because then what's going to happen? Market is probably going to go under. Bad things are going to start happening, and then you're going to be collecting checks 1 month after another for a period of months. So the indemnities tend to be clustered for many months in a row once they start. And then the payments also tend to be clustered. Now, if you could guess, okay, well, now the next 2 years, there are not going to be any payments, so I'm not going to pay anything, and I'm going to come back for that next cluster. Yeah, if everybody could do that. But if you were that good at that, I would imagine that right now you would be somewhere in Caribbees with your 6,000 square foot house on the beachfront, etc. If you had the ability to guess what markets are going to do, there are many more ways to monetize than just livestock insurance. And if that's not the case, if you're somewhere in Ohio and Indiana today, then I would suggest that we all recognize that we need to be modest about our ability to forecast what markets are going to do, and instead of trying to outguess the market, let's see how do we set a responsible, low mental bandwidth strategy in place that makes your farm more resilient, your operation more resilient, and increases your income over time, not in one particular event. Okay, so the other decision to make is like, how far out do you go? Do you buy feeder cattle for 13 weeks out, which is the shortest, or do you go further out? And our results suggest that the net indemnity was the highest for if you in this case 21 weeks had the highest net indemnity. You can see that 26 weeks tended to be better than 13 or 17. The problem with this kind of analysis is that over the last 10 years until very recently, there weren't a lot of offers that would go more than 30 weeks out. You can see that 39 weeks, like the number of events available for evaluating this strategy falls off dramatically. So take this with a grain of salt. I would say that it makes most sense to buy coverage the moment you assume risk, particularly if you can pencil out how much would it cost you to feed cattle of the period that you own them, and if you can lock in a profit by putting LRP on early. I don't know a single producer that lost their farm by booking in a profit. That would be quite an achievement. So if there's an ability to book in a profit, do it, even if it's early, preferably if it's early, if there's a long time until then. Now I want to talk a little bit about fed cattle. The return per head over the last 10 years are not great. In fact, they're negative. And fed cattle programs, I'll be honest with you, had some shortcomings. As it currently exists, it's not something that I recommend to producers. We have worked with agents, with producers, and with risk management agency to revamp fed cattle LRP. And as of July 1 of this year, so just over 5 weeks from now, there'll be let's call it fed cattle 2.0. Everything is IT, versions these days. The fed cattle 2.0, I believe, is going to be better than what you could buy over the last 10 years. First of all, the quality of the meat has changed over the last 15 years. So the 35 to 65% choice used to be the dominant category back 15 years. But you can see that the cash sales of that category have trended down. Now there are even some weeks where there's no sales at all. And then the over 80% choice has not been a very popular category, not very liquid cash markets 15 years ago, but it's trending up over time. So what the change that we made is to settle LRP fed cattle against the over 80% choice instead of 35 to 65% choice. So that means higher expected prices. That means expected prices that are more easily compared with CME. And it also does mean higher actual prices, but overall, we believe that this program will perform much better, or that it would have performed much better for producers over the last 10 years than the numbers that I've shown you on the previous slide under the old design of the fed cattle. On the LRP swine, we have just the inverse of LRP fed cattle. The returns are astronomical. For $9 per head paid in, you would collect $14.80 or a net indemnity of 556. That's 60% return. At that point, you must be thinking Marin Bozic must be new Bernie Madoff. There's some sort of Ponzi scheme going on here. It's not. The LRP swine, reflects the fact that we just happen to have a lot of disturbances, a lot of stress on the pig market over the last 10 years, and the indemnities have been more frequent, 45%, with gross indemnities, 39% net indemnities. So that's matching feeders there, and the returns are just good. So I don't think that there's anything particularly wrong with the LRP swine, the way it's designed, that's just the way it is. Like if you're a pig farmer, this is seriously a program you should look into. And the same thing applies as we discussed before for feeder cattle. If you go with a lower deductible, that's going to yield typically higher net indemnity. And then as far as evaluating the performance, how many weeks out to go, I would hesitate to offer any definitive conclusions there, because swine did not really have the ability to go beyond 26 weeks for longest time. It's just very recently that we've introduced that, the unborn swine type, etc. I would say it makes a lot of sense to book LRP coverage once you have assumed the responsibility for feeding those piglets. Probably 26 weeks out is what I would suggest be your starting point for debating which way to go with LRP swine. LGM swine also had a really strong performance. Returns here are just ridiculous. For $1.83 per head paid in, you would collect $4.44 over the last 10 years. And frankly, this program is not well designed. This one is just like LRP fed cattle had to be redesigned because it was not generous enough to producers. LGM swine, at least the way it exists currently, is too generous. There are some rating deficiencies there that we are working to address, and some of those changes will hit the market July 1 of this year. Some of the changes will hit the market July 1, 2024 as well. We all, of course, want producers to have a well-subsidized product, but 143% return is not how this program is rated. So for now, if you use it, it's a pretty good investment. It's a crazy good investment right now, but just keep in mind that this is not going to be a stable futures. We do need to make sure that there is that everybody in the supply chain is treated fairly, including our reinsurers, our AIPs, who are bearing the risk on these programs. We are on the verge of actually having some AIPs deciding not to carry LGM anymore because they have recognized that there are some rating deficiencies. I convinced them that I'm very serious about making sure that these programs are actuarially fair before subsidies. So I hope we keep them for the next year until we have a chance to update this as well. Okay. I'm going to skip a few of these details because we are bumping across the time. I just want to focus on DRP returns over time. Here's the net return. So DRP only started in October 2018, but we recasted it like what would have been the case. In this case, example is Indiana, if DRP had existed since 2011. So on the class 3 and class 4 side, they behave slightly differently. On the class 4 side, the net indemnities would be rather high, especially particularly if you hedge further out. So if you go 3, 4, or 5 quarters out, net indemnities were in some cases over $0.50 per hundredweight. On the class 3 side, they're negative. I would say that there is always some elements of luck in this. 10 years is not a terribly long period of time. And you can see that even if you were just selling futures on class 4, you would make money. On class 3, you would lose money. So this is indicating that that there's some element of luck maybe if we didn't have 2020 presidential elections, maybe we wouldn't have farmers to families food box program. So the class 3 may not have rallied as much as it did 3 years ago, and maybe the returns on selling Class 3 futures would have been much higher. So things like that. There's always some idiosyncrasies there. But whichever way you look at it, you can see that you can beat the futures markets considerably by buying DRP as opposed to selling futures. The last thing I want to point out is that, let me see if it kicked me out. Oh, yeah, it did. Last thing I want to point out is that we have a livestock insurance analyzer that is, okay. To this one. We have an analyzer that is exclusive to farm credits, and you can see various analytics for LRP. We're looking at the LRP quarter currently, where you can choose different dates, you can travel back in time, evaluate different coverage percentages. You can look at how this compares with puts. So you can see in this particular case, I'm showing that the LRP is about a third cheaper than the equivalent CME put. You can look at historical performance. So if you were buying something on each of the previous 12 years, which year would it paid out, how much it would have paid out, etc. You can track your endorsements. And so if you book some coverage, you can track it over time. Is it likely to pay out? Is it not likely to pay out? And we have this for LRP. We have it also for DRP, various ways to look at market dynamics. So you can look at the calendar, when is it available, when it's not available. You can set alerts so you can get an email or a text message when prices go above or below a threshold that you've set. You can look at what the spot market is doing. Today, we didn't have the trades yet in the spot market, but you can see what's going this week versus previous 2 weeks. You can look at how the prices are for the next 5 quarters, current prices, previous prices, last 7 days, 30 days. So it's a fairly rich tool and constantly evolving tool that helps you as a producer make higher quality decisions. In fact, you can the sales now close, but before 9 o'clock Central or 10 o'clock Eastern, you could actually just press a button here to send a message to Sterling that you want to buy coverage, and it can all go very, very smoothly through this, and then the DocuSign goes out, etc. So happy to go into more details, answer any questions. Again, this is not a webinar where you leave and, oh, now I understand DRP in the full detail for LRP as well. I wanted to get you curious about these products. I wanted to get you interested. I want you to see that there is some benefits here that you should explore. But the next step would be to call Sterling and ask him to walk you through this, to work with your operations data to see how this would help you. And I'm always at your service. Sterling has me on speed dial. If there's any question that I can be of help with, he can quickly pull me into that conversation as well. So, Micah, back to you.
Yeah, I think we've got about 2 minutes. So, Sterling, if you want to just introduce yourself and share with the audience what you'd like to share today, that'd be great.
Thank you very much, Marin. I couldn't have said it better.
Maybe my headphones died.
If you ever decide to change careers, I'm sure we could find a place for you at Farm Credit. But no, my name's Sterling Watkins, livestock product specialist for Farm Credit Mid-America. These tools have been very beneficial to our customers and our prospects. Do not hesitate to contact me at 574-453-1975. That's my cell phone. I'm available when you're available, and I would love to help you mitigate your risk and increase your revenues. So that's really about all I have to say. Again, I encourage you to give me a call. We want to help you.
Awesome. Well, if anybody has any questions or follow-up questions that we can answer, we're butting up against time here, but we thank you for joining us, and we hope that each and every one of you have a fantastic day and great rest of your week. Thanks again to Dr. Bozic and Sterling for joining us, and everybody take care. Thank you.
And it's Luke,
Thank
not
you.
Mike. I apologize, Luke.
That's
So-
okay. That's okay.
All right. Okay. Have a good day, everyone.